Today, Matt Cochrane and I are discussing Buffettology. This was a book written in the late 90s by Mary Buffett, who was previously married to Peter Buffett. After getting divorced, she wrote this book about what she learned about Buffett's investing methods from interacting with him and his family. I think it's a pretty good summary of Buffett's investing approach, especially for people who are unfamiliar with it. It's special to me because it was one of the first books I ever read about Warren Buffett. So I read The Intelligent Investor first after someone recommended it to me. And then I read this and things really started to click for me and I got very interested in it. If you're like a Buffett aficionado who's read everything about Buffett, a lot of the insights might seem basic to you, but that's sort of the point. I think it's an introduction to all of Buffett's concepts and it summarizes them very well. So you don't have to read 40 years of annual letters to get at it. And I think it really distills his whole philosophy in a pretty accessible way and a very practical way. It shows you exactly the kind of things that he looks for. Something I really like about the book is that a lot of the Buffett books lean in kind of one direction or the other to the qualitative or the quantitative. And I think that the way that this book merges the two, there are quantitative sections of the book about basically how to calculate the net present value of future earnings. And then there's a lot of qualitative stuff about how to look for good businesses. And it was really fun revisiting the book. I don't think I've read it in a long time. So yeah, I enjoyed it. Matt, what did you think of it?
Yeah, Value Stock Geek. Thank you so much for having me on again. Another great book. I mean, this is I think we're closing in on close to a dozen books now. We've gone over together, and this is a good one. And I can see why a lot of people who started off with this where they're coming from, and it's a great introduction to Warren Buffett's investment philosophy, and without question, one of the world's greatest investors that's ever lived. So if you want to be a good investor, it makes a lot of sense, I think, to study the greats and to see how Warren Buffett became so good at investing. And you're right, probably the most interesting chapters were the ones where it was talking about how Warren Buffett learned about valuation from Benjamin Graham, and then how he evolved from that, basically with the teachings or philosophy from Charlie Munger and Phil Fisher. Another book, two other books we've read. Mm-hmm. So I thought just there's some chapters that are almost one-offs, but just really interesting. I like the chapter on inflation, for instance. It's very, very basic, but something that is pertinent to investors today and how to think about inflation just from a very big picture perspective. There's other chapters on just short-term arbitrage plays, which I really enjoyed, some stuff that you would normally consider that falls outside of Buffett's classic investing anyway. But it was a very interesting book, very good, and I'm excited to dive in.
Awesome. So what'd you think of the stories at the beginning of the book, how Buffett at Christmas would hand out $10,000 in cash and stock tips? What do you think about all that stuff?
Right. Well, it's interesting, right? And certainly Mary Buffett, who as you mentioned wrote the book, has an interesting relationship with Warren. Do you know what I'm interested in? Do you know is this still an amicable relationship she had with Warren, as she was writing the book, or was this kind of like I was just kind of curious as to how that interplay worked.
I think it was unauthorized. I don't think that this is a book that Warren endorses in any way. It's not like the Roger Lowenstein book is probably the one that you'd see at the Berkshire meetings. I've had some people on the podcast whose books that he seems to enjoy. There's a good book, The History of Berkshire Hathaway, which was really interesting. And then I also interviewed Brett Gardner about Buffett's early investments, which was another fascinating book about him. There's The Snowball, which is probably the most comprehensive one about him. He gave Alice Schroeder, did you read The Snowball?
Yes. So no, I haven't.
Okay. That's a good one.
I know we probably came, I think our investment styles are pretty similar now, but I think we came from opposite ends. I think you started off more as a value investor, and I started more off from the growth side. Like my first investing books were the Peter Lynch books and Phil Fisher. Like
Oh,
that's what I
okay.
was told to read, and those were like my, for lack of a better term, like investment Bibles. You know, like, oh, learn this and you understand how to like invest in the Motley Fool way of just, buy quote unquote great companies and just hold on to them forever and never sell. Now, I will say, like that being said, like I read an ebook early on and I cannot remember the name of it, but it was just kind of like lessons from Buffett's letters. And that gave me like some grounding and valuation that I needed early on. And I was always very appreciative to have that, especially as we've gone through like some cycles in the last 10, 15 years where stocks probably got pretty far ahead of themselves.
Hmm.
But no, I have not read a lot of Warren Buffett books. I mean, I know the well-known stories, of course, but like I think this was one of the first books I read that was solely about Warren Buffett.
Maybe our next episode should be about the Lowenstein book, Making of American Capitalist. You ever read that one?
I did not see.
That's a good book. Let's
All right,
do that.
do it. Got it. We already got it
Um,
set up.
yeah. And so yeah, Lowenstein, that was written in the 90s. And that's like a great, that's just a great book about him. Snowball. So Alice Schroeder she was given access to Buffett's records for like 5 years, like his personal records, journals. That's like an encyclopedia about Warren Buffett. Hasn't disavowed it, but he doesn't endorse it. And that gets into some of the really painful aspects of his personal life. So it's about like divorces and some of the stuff he went through. So I think, and he told her, write the most unflattering portrait available. And, that might sound good in theory, but I think once you read it, it's tough. And she went to places I'm not sure he was comfortable going, but that's a good book too. But like a little bit, I think the Lowenstein book is kind of like the classic. This is what all of Lowenstein stuff is great. He's a great writer. He is a Substack too. It's pretty interesting. But
It's
anyway, you go ahead.
it's interesting, and this book doesn't touch on it, so we don't need to spend much time on it. But like, it seems like to be like the best at something, like whether you're talking about Michael Jordan or Steve Jobs or Warren Buffett, you're wired just a little bit differently, and,
Mm-hmm.
and it just seems like your personal life is always kind of like just caught up in that, just because you're wired differently, and it can be what makes you so great at something at some field because you can just dedicate yourself to it mercilessly, but it also makes kind of just messes up your personal life, it seems like, in the process.
Yeah, and I think that's a very good description of Buffett in the 50s and 60s, who was just 100% committed to investing. And like when I was talking to actually Brett Gardner about that other book, Buffett's Early Investments, it really becomes because you think of Buffett as like, oh, he's hanging out in his room combing Moody's annuals and then finding like the cheap stocks. But like that's not the truth. Like like the level of work that he did, like visiting, actually, going to a company and knocking on the door and figuring out what was going on. I know one company, he went like door to door to buy shares from individual investors. Like this man was a machine, and that's got to come at the expense of your personal life.
Yeah, it's wild. I will say, like, what's interesting is, so we've read some older investing books now. We read like Peter Lynch and Phil Fisher, which those books were Peter Lynch's books, I think, were written in the late 80s, early 90s. Phil Fisher's book, I think, was written in the 60s, at least the first edition. And this book, it was written in, I want to say 96, 97. But what's interesting is it's still before the internet era. And so some of it still reads like, wow, this is the old days. Like,
Yeah, she's talking about.
you're talking about the pre-internet era and just things were different. I mean, there's parts of the book which just in all those books just have things that were probably just a little dated, like talking about going to the library and checking out this manual of stocks so you can like research your stock this way, and you go to the microfiche and find an article in Forbes about it, doing this, and it's just like, wow, like what, when you read it now, it's just like, wow, what a bygone era. And it's only 30 years ago, or a little less than 30 years ago, but still, it was just before the internet. And some of this book, and not a criticism, just like when it was written, what you can just tell was like some of the advice in this book, like the others we read too, are just like a little like, you probably wouldn't do it like that these days. But like, and same thing, like with you talk about like Warren Buffett going door to door to buy stocks. I mean, that's just wild to me.
Yeah.
Like to hear something like that. Like that's just like, like that is just that seems like 200 years ago when you would have done something like that.
Yeah, well, she gets into like how to order an annual report in the book. Now you just go to sec.gov, boom, it's there. She gets into
Right.
like how to use the Texas Instruments financial calculator. There's a lot about that in there,
Right. Right.
which you can do in Excel these days, so you don't really need that anymore. But yeah, it is a portrait of a period of time before, and it was written right at the cusp of it in 90. It was
Yes.
written in
Yes.
97. I read it in 2000, I believe, and it already had seemed a little bit like, oh well, the internet's making this a lot easier at
Right.
that
Right.
point.
Right.
Yeah, so
Right. Right.
it's crazy how fast things move in this world.
Yes, I do want to say so. Like, just diving in, like she talks. She also uses terms that that I don't think are used too much anymore. But as
Mhm.
soon as you understand what she's talking about, it makes a lot of sense. So she would say like this book is about business perspective investing, and so she goes. Folly and discipline are the key elements of Warren Buffett's philosophy of investing. Other people's follies and Warren's discipline. Warren commits capital to investment only when it makes sense from a business perspective. It is a business perspective investing that gives him the discipline to exploit the stock market's folly. Business perspective investing is the theme of this book. And she starts talking about it. And then, like, as soon as you realize, like, she just means, like, Warren Buffett wants to be a long term owner of a business. And when he buys stock in a company, that's how he sees it. He's not buying it for technicals or a quick trade or for next quarter's earnings or a catalyst. He wants to be a long-term partner in a business. And it's just terms like that. Or she'll say like consumer monopolies. And a lot of times, like she's really talking about like economic moats, just businesses that have some kind of economic moats, which we reviewed Pat Dorsey's book, which was all about economic moats. And I think that's a more common term to investors these days. I don't think it's unusual for investors to hear the term moat. I don't think but not too many people talk about consumer monopolies. So just those two elements of the book, it makes it just seem like some of the terms she uses, which aren't used too much anymore, and just like talking about going to the library or like, okay, now if you have your Texas Instrument calculator, punch in this key and this key to calculate this, and things like that. Just give it probably it makes the book seem a little older than it actually is, I guess.
Yeah, absolutely. And yeah, I liked the emphasis on stocks or ownership shares of businesses. Like when I first got into investing in like the late 90s, I really first thought of it as like, oh, these are numbers jumping around on a screen. And you just like, that's how I kind of like started before I discovered all this stuff. And for me, it was a revelation when I first, between Graham and Buffett, this concept that stocks are ownership shares of businesses, and that's how you should think of it. You shouldn't think of it as like this video game that you're playing. Like you should think of it as like I am. If you were to buy a business down the street, think about it in the exact same way. And it seems basic, but the thing is, I don't think most investors still behave that way. When you see people, the way they invest and the way they talk about stocks and how quickly they move in and out, it's hard, I think, for people to actually implement in reality, even though that's what it is and it seems logical. Yeah. So why do you think that is so difficult
Well,
for
it's
people?
really easy to talk the talk,
Yeah.
but
Yeah.
not walk the walk, right? I
Hmm.
think most people would say, "Oh yes," like when they hear that, like that's what I do, or that's what that's what I want to do. I don't think that's how most people act, and I mean, I think it just goes back to very basic human psychology. Like, when you get excited about a company because maybe I read it in your newsletter, or maybe I read it in a Motley Fool newsletter, maybe I saw it on Twitter, wherever. Like maybe, you can get an idea from anywhere and you get excited about it and you see like two or three good things about it. And you know what? You go, you know what? I have $1,000 sitting in my brokerage account. I'm going to invest in this company or whatever. But if you don't really know that company, when it goes down 20% in the next year, I mean, I've done this a million times, so I'm very familiar with it. And you just don't know whether is that a great buying opportunity, or is that like something's fundamentally wrong with the business? And it's just funny how your psychology changes so much from that pure excitement when you buy it because you're like, oh, this company is going to go, nothing but up. This is a Sherlock double, in the next couple of years. And then when it starts to go down like that, and then you get tired of it, and then maybe you double down once, or you buy more as it goes down, but then it keeps going down. And when you really don't know a business, like it's just like you can't borrow conviction. Like I can't borrow conviction from you, no matter what. Like if I don't know that business, like I can't read your newsletter and say like, okay, I'm borrowing Value Stock Geek's conviction, or I'm borrowing Matt's conviction because I saw him talk about this idea on X. At the end of the day, you can't borrow that conviction. You have to know a stock in a company, and if you don't have that, your psychology is just going to mess you up because you don't really know deep down whether, it's down 30% now, it's down 40% now, which will happen to probably almost every investment you ever buy at some point. And if you don't know, like whether that's just a better buying opportunity or whether something's fundamentally wrong as sentiment turns. And when that sentiment turns, all you're going to be reading is the negative things, right? So, you got to be able to look past that. Is that like short-term rain clouds that you need to be able to see the sunshine on the other side of that? Or is that just like, oh, this business is just dying because it's part of a bygone era or whatever? And if you don't know that, like, you're going to screw yourself up, and you're going to sell it possibly at a very bad time.
Yeah, 100%. And I mean, like you said, every stock goes through serious drawdowns. So you could pick the greatest companies that have ever existed, whether it's Monster Beverage or Apple or Tractor Supply or whatever. And you're going to find many 20% drawdowns. You're going to find probably a dozen 40% plus drawdowns. So, I mean, when that happens, it's real easy to listen to people who are like, yeah, this used to be a great company, but it's over and everything sucks now. And like, unless you understand the company, you're going to agree with it.
100%. Like Morgan Housel once wrote an article, and he wrote this. I mean, he wrote this like probably a decade ago, and he was talking about like the best performing stock of the past decade, which was Munster Beverage at that time. So I think he was talking about the time period like 2005 to 2015, and he talked about like again best performing stock of the last 10 years when he wrote this article, and it was up. I mean, whatever, a gazillion percent in this time, right? And he was talking about like what a nightmare it must have been to own it because it had so many drawdowns, like one drawdown of like 70%, another completely separate drawdown of 60%, and then like four drawdowns of 50% or more, and like 10 drawdowns of 20% or more. And just talking about like, you would think like, oh, if I owned this stock, like, I mean, man, the last 10 years must have been great and how wonderful it would have been. And he was just talking about like what a nightmare it would have been, like holding this through. And if you didn't really know the business, like how many times like the average investor probably would have just sold it along the way.
Absolutely. So with the book, one of the things I liked about the book was a framework that they talk about a lot, where you should think about stocks as bonds with variable earnings that can grow over time. And I think that's a very powerful way to think about an investment. What did you think about that whole framework?
Yeah, so it was one of I enjoyed a lot of this book, like I already said, and we'll get into all that. But a lot of it's like stuff I knew. But like two things I really appreciate about this book. One, it helped me really understand like the predictability of earnings and how important that is. And not that I didn't know that, but like I don't think I quite understood what Buffett always meant by circle of competence before I read this book. And then two was like, yes, like comparing stocks to bonds and how you value it. In fact, like I know I highlighted a passage about that, but like you have to compare like a stock's valuation and what your expected returns are to what you could get in a guaranteed rate to a U.S. Treasury bond. And yes, that's definitely an important concept. And once you understand that, you understand why when interest rates go down, why stock values go up, which we saw the last 5 years play out.
Yeah, both ways. Yeah. And so I think that's an important concept. So when you are buying a stock, the key, it's really you are buying a future stream of cash flows and earnings. And it's all about the present value of those cash flows and earnings. So being able to predict those earnings is pretty much the only way to succeed in single stock investing. And I think that's important because there's so many businesses where you cannot predict the future stream of cash flows and earnings. And that's what this book gets to, is that like what Warren Buffett is trying to do is only buy businesses where he feels a level of confidence, that circle of confidence that you were talking about, where he feels like he can predict future earnings. And I think that's an important concept too, is only focusing your universe on companies that have some level of predictability.
Yeah. So about what you were talking about, like comparing the stock price to the bond, here's that paragraph. He goes, she goes, now Warren believes that all rates of return ultimately compete with the rate of return that is paid on government bonds. He believes that the government's power to tax ensures the bond's safety, and investors are very aware of that. He believes that this competition of rates is one of the main reasons that the stock market goes down when interest rates go up, and why the stock market goes up when interest rates go down. A stock investment that offers a 10% rate of return is far more enticing than a government bond offering a 5% rate of return. But jack up interest rates to the point that the government bond is offering you a 12% rate of return, and the stock's rate of return of 10% suddenly loses its appeal.
Exactly. Yeah. And I mean, you can think about that too in like an historical context. Like, why did stocks do so poorly in the 70s? And it's like, well, interest rates were going up to combat inflation. And like, if you're in 1980 and you can buy a bond that gives you 15% a guaranteed, why would you even mess around with the stock market? Like the stock market historically is going to do 10%. Like, so that's the calculation that a lot of investors make. And that's why stocks got so cheap in the early 80s and the late 70s, because you had this alternative that was totally risk free and offered you an extremely high, crazy rate of return.
Yeah, absolutely. Absolutely. And then about circle of competence. And I like the point she makes here. She's talking about Microsoft as an example. And she goes, Warren often refers to a circle of competence, using Bill Gates and his incredible company Microsoft as an example. He will say that Gates is probably the smartest and most creative manager in the business world today, and that the company is super. However, Warren says he is unable to predict with any comfort what the future earnings of the company will be, and thus he can't calculate Microsoft's future value. If Warren is unable to calculate a company's future value, then the company will not fall in his circle of confidence and he will not consider it for investment. In Microsoft's case, he says that he just doesn't understand the business well enough to evaluate it. And if he can't evaluate it, he's not going to invest in it. And I think, like, especially when I first started investing and I would read about Buffett's circle of competence, like, I think it just meant like, when I would see something like that, oh, he didn't invest in Microsoft because it fell outside his circle of competence. I took that to mean like, oh, he this technology, this newfangled stuff, I don't understand it. So I don't understand what Microsoft does, or I can't understand this company, so I don't invest in it. And what I appreciate more now, and especially after reading this book, is that it really just means he doesn't understand what, like, if he can't predict with like what he considers like his, like, like, if he can't predict with like some level of certainty how Microsoft's earnings are going to do in the next 10 years, then that's outside his circle of competence. It's not that he doesn't understand what the company does or that he can't understand technology. It's just that, like, he wants to understand what a company's earnings are going to do in the next 10 years. Not next year, but over the next 10 years. And if he can't do that with a certain degree of certainty, it's just going to be outside his circle of competence, and he can pass on it. And I think that's important because, like, no matter what, right, there's going to be companies, like, no matter what kind of investment philosophy you have or approach you take, there's going to be companies that fall outside that circle of competence for you, and you're going to miss some great ones, and that's okay. Like, there's no investor ever who hits all the great companies. You only need a few to really make a difference in your investment career, and you just have to say it's okay. It's okay if I miss this.
Yeah, exactly. And I think it's important too to when you're thinking about this concept, like, okay, I want to only buy businesses where I can predict their future earnings. I think it's also important, which the book talks about too, is what kind of companies can you not predict? So I think the first category that she talks about is commodity like businesses. So any business that's like, there's no secret sauce, it's dependent on the price of a commodity. It's going to be, especially a volatile commodity, it's going to be practically impossible to predict those sort of earnings. What you think about that whole concept?
No, 100%, right? So she talks about like the way she broke down the two types of business was like a commodity type business and an excellent business, which she quickly categorized kind of as a consumer monopoly.
Mm-hmm.
She's talking about a commodity business. She's basically just talking about like how it's a race to bottom. It's all about price. She goes, all these companies sell a commodity for which there is considerable competition in the marketplace. The price is the single most important motivating factor for the consumer making a buy decision. One buys gasoline on the basis of price, not on the basis of brand.
Mm-hmm.
It doesn't, she goes, it really doesn't matter where the corn you buy in the store comes from, as long as it is corn and tastes like corn. The intense level of competition leads to very competitive markets and, in the process, very low profit margins. In commodity type businesses, the low cost provider wins. This is because the low cost provider has a greater freedom to set prices. Costs are lower, therefore she goes on. But like, yeah, it's a race to bottom. It's all about price. There's no differentiation between like, when you buy your corn, you might buy it from a certain supermarket, but you're not like looking to see where the corn comes from, at least the vast majority of people. Or when they go to a gas station and one gas station is selling it for $3 a gallon and the other one selling it for $3.30 a gallon and they're right next to each other, you're going to the one that sells it for $3 a gallon.
Right. I agree. And yeah, there's a lot of commodity like this. So it's probably important also to distinguish. So we're not necessarily talking solely about like actual commodities. So we're not talking about like gold miners, although this gold miners fall into this bucket, but we're talking about anything where a consumer is totally where all they care about is price. So, I'd say other examples would be airlines. So you want to buy a ticket to go to some other city. You do not care. There's no differentiation. Like you fly American Air, Delta, or whatever. Like it doesn't matter. Like you just want the ticket and you want the cheapest possible ticket, and it doesn't really matter. So that's a business. Then that's why airlines as a group deliver terrible returns over time. So, I guess another example would be autos, like all of the auto companies put together have delivered very poor returns for investors over the years. And it's because, it comes down to quality and there's some brand there too. But like one of the companies I think might have like a good brand would be like a Ferrari or something. But for the most part, for people like me who are never going to buy a Ferrari, it's like I'm looking, okay, what's going to last the longest for the least possible price and it be reliable. It won't break down on me. Like it's not, crazy stakes. And then, so those are just examples of businesses that we would define as like commodity kind of businesses. And it's practically impossible to predict their future earnings. So it's best to just stay away from them.
Yeah, exactly. And she talks about like she gives a list of like the basic characteristics of a commodity business. And it's like low profit margins, low returns on equity, absence of any brand and name loyalty, a presence of multiple producers, existence of substantial excess production capacity in the industry, erratic profits. And that's something she talks about a lot. And I think it's a very important point. Like she talked about like looking at the last 10 years of profits, of earnings. And like if they're kind of all over the place, they're up and down, up and down, up and down. She's like, that's probably a commodity business. If it's up, consistently up, whether it's 10%, 15%, what have you, she's like, that might be like an example of an excellent business. Obviously, more investigation is needed, but she talks about that. And I would say, yes, I think that's a very good, like, if you want like to look at a company for 10 seconds and see what kind of business it is, that's a good way to do it. And then profitability almost entirely dependent upon management's abilities to efficiently utilize tangible assets. And those are the characteristics she gives to commodity businesses.
Yeah. And you can make money in commodity like businesses, but the thing is you need to be at the right point in the cycle. So, a commodity like business is going to go through tremendous ups and downs. And then like a smart investor would say like, oh, well, I'm going to buy when it's bombed out and then I'm going to sell when it goes up. But the problem is, and I heard Terry Smith, I actually used to do some of this stuff. And Terry Smith actually convinced me of this. He's like, well, yeah, he's like, this guy will say he's going to buy at the low and then sell at the high. And he's like, I've never actually met anyone who can do that. And I haven't either. And I couldn't do it when I tried to do it. So it's way easier than it looks when you look at like the chart of the stock going back through history. You're like, oh, it's a cycle. I'll buy at the bottom. I'll sell at the top.
Right,
but,
right.
Like
right,
it never
right.
works. It never really works out that way.
Yeah.
Yeah.
Yeah. They don't ring. What's that saying? Like they don't ring a bell at the top, right? I
Yeah.
mean, there's no one there to tell you like, oh, this is the top, it's time to sell, or this is the bottom, it's time to buy. Yeah, it's a lot easier to do that when you're looking at a chart of the last 10 years than to be able to predict that for the next 10 years.
Totally, totally. Like a good example, I think, is the energy sector. So like it's funny, like energy investors were really kind of cracking open the champagne bottles in 2022, saying like, look, it was so easy. Like oil went negative and it was an all-time low. And then they've kind of sucked since. And then at the same time, I was hearing the same arguments in 2018, like when oil was about to go through a horrible period. So and they were making the same arguments. Oh, it's low as a percentage of the S&P 500. Look at how cheap it is historically compared to every other asset. And like it's just not predictable. So anyway, yeah, I think it's just best to avoid unpredictable businesses.
Definitely, definitely. So then she compares that to the consumer monopolies, right?
Right.
These are the commodity businesses, no differentiation in product, no brand name loyalty, erratic profits. And then she talks about a consumer monopoly, and she compares it to a toll bridge, which I liked. The toll bridge is a classic form of the consumer monopoly. If you, the consumer, want to cross a river without swimming or using a boat, you very, very likely have to cross on a bridge. And use the bridge, you have to pay the toll. The toll bridge has a kind of monopoly on crossing the river at that particular place. The same can be said when a large town has only one newspaper. If you want to advertise in the paper, you have to pay the advertising rate the paper is charging, or you don't advertise. This consumer monopoly gives the toll bridge or the newspaper a greater freedom to price, which means greater profits for the shareholders.
Absolutely. Yeah. And she has the toll bridge is a good way to think about it. And that's a recurring theme in Buffett's talks and writing is like when he was a kid, he thought about this concept of like a toll bridge. Like, wouldn't it be great to own a toll bridge? Like people have to cross that river and they have to pay the toll no matter what. And wouldn't it be great to own that steady stream of income? She also has, I think, a good checklist for identifying these consumer monopolies. So, or great companies. The first checklist item is like, does the business have an identifiable consumer monopoly? So we just talked about that, how that's an important concept. The next one was, are the earnings of the company strong and showing an upward trend? So we touched on that too. Like you don't want to buy a business where earnings every year are like just all over the place, up and down. You want to see some upward stability. The next one was, is the company conservatively financed? So you don't have a lot of debt, because if there's a recession or there's some problem in the business, that can turn into what would be a normal downturn could be catastrophic in that kind of situation. The other one was, does the business consistently earn a high return on equity? The other one was, does the business get to retain its earnings? I don't think that's something that a lot of investors emphasize enough, this concept of, are they retaining its earnings? And I actually think one good metric to look at to pinpoint this is to look at book value per share. So if you see a company and you map it out over 25 years and you see that book value per share constantly increasing due to retained earnings, I think that's a good indication you're probably dealing with a good company. The other one was, how much does the business have to spend on maintaining current operations? So that's really all about free cash flow. Does the business generate cash that can pay for its current operations instead of having to like borrow money or issue shares? Like, can they just sustain themselves based on the cash that they generate? The other one was, is the company free to reinvest retained earnings? So, and does management have a good track record of doing this? And then the other one was, will value added by retained earnings increase the market value of the company? So that's the checklist. I thought that was a nice little way of thinking about it.
Yeah, no, she walks through those like very well too, like giving examples of each. Like for instance, like she about like how much does the business have to spend on maintaining current operations, which I think it's especially pertinent if you're investing in a lot of the Mag 7 today. You're talking about especially like Amazon, Microsoft, Google, like they're building out their cloud operations and they're growing. And it's very important to do all you can to like recognize like, okay, how much are they paying? Because they're spending, I mean, billions on CapEx, right? Meta 2 is another one, like spending all this money on CapEx. And if you can't discern, like how much are they spending on CapEx to maintain what they have? And how much are they spending on CapEx to grow into the future? Like it can quickly like get dicey if these are if they're realizing good returns on their capex. And so I thought that was interesting. She talked about General Motors and about like she talked about like I think from like 85 to 95 and just how like they spent so much on capex and like you the share price didn't do anything in that decade. And I don't know if the share price has done anything in the decade since either. So I mean, you just have these companies like, they're just spending like all their earnings on capex to maintain current operations and not to grow. You're going to quickly see like any earnings or investment gains like dissipate.
Yeah, and GM's a good example. Like 10 years later, so she wrote the book in 97, 10 years, 11 years later, they're going bankrupt. So,
Yeah, that's right.
pretty good advice there to avoid that sort of business. Yeah. So I thought that was important. And then, yeah, I think that stability of the business is also a really important concept to not only be able to predict it, but it's just a good indicator that you're dealing with a pretty good business. Like if you see earnings go up, I would add to that margins. If you see stable or increasing margins, probably a good hint that you're dealing with a really good business. If you see margins all over the place, like, 1 year they're sky high, the next year they're negative, like it's probably not a particularly good business with pricing power.
What did you think of so she puts like an exact number on the return on equity that she's
Mm-hmm.
looking like that or that Buffett was looking for, like which is 15%. And she don't get me wrong. I mean, she walks through it like why they're looking for 15%. But what did you think of that, putting an exact number on that?
I think that's a good way to think about it. Like the theory would behind it would be if you were to own a business, you're basically going to earn the return on equity. Like if you were to buy this business, like assuming you bought it at like book value or whatever, like that's your return. So if you're targeting, and she talks about how Buffett targets a 15% rate of return, I don't think that's really possible anymore at his size and the
Sure,
valuations in the market.
sure,
But
sure,
back
sure.
then, that's what he was doing. He was trying to find 15%. So, yeah, if you're targeting 15%, that's what you want to do. I mean, on my newsletter, what I try to do is I try to look for 10% because I think that's good enough. But yeah, I look for that in ROE and ROIC. You want to see at least 10%. And that just is an indication that like that company will compound in value over time. Like I was talking about earlier with book value per share, that's going to generate your retained that return on equity is going to generate your retained earnings. That's going to increase the value of the business over time. So yeah, I think it is good to target high ROE. The mistake you can make with this though is if you're just like running a screen of high return on
Oh,
equity
right. Yeah.
stocks. I think the trap you can run into there is you can identify a lot of businesses that have had very high ROI recently, but for most companies that tends to mean revert. So you'll buy something at a high ROE and then or high ROIC, and then eventually competition or just the cyclical nature of the business is going to take that down. So it's really important to go through, I think, the qualitative exercise to determine, is this going to be sustainable? Is this an ROE or ROIC that they'll be able to sustain for a long period
It's
of
something you
time?
should look at that too. Is just like making sure they're not using debt to buy back shares or something like that, which can really drive up ROE. Like you can see like a super high ROE with like out of nowhere. Like I'm just like far above like anyone else in their industry. And you're like, whoa, what's going on? Like, why does this company have an 85% ROE and everybody else in the industry has like much lower? And a lot of times that something like that could be like they're just using debt to buy back shares or something, which might even be a good idea. I'm not saying that was a bad idea, but just things to look at.
Yeah, absolutely. Yeah. And you can get like, that's why I think ROIC is probably like a better metric, but ROE is still great. But the problem with ROE is you can manipulate that by increasing debt. So you just reduce your book value and then automatically your return on equity is going to look higher. And that's definitely not a good thing most of the time.
Right. The other thing that she talks about here, and something I use today, is she has this test for testing companies to see if they're consumer monopolies. I would
Mm-hmm.
say this is a test to see if a company has an economic moat, but I think it's a very useful test. She goes, In testing for the presence of a consumer monopoly, he likes to ask this question. If he had access to billions of dollars, which he does, and his pick of the top managers in the country, which he does, could he start a business and successfully compete with the business in question? If the answer is a resounding no, then the company in question is protected by some kind of strong consumer monopoly. In Warren's world, the real test of the strength of a consumer monopoly is how much damage a competitor could do, even if he didn't care about making money. She says, could you start a chewing gum company and compete with Wrigley? Several have tried and several have failed. How about that Hershey chocolate bar? And what about Coca-Cola? Like, so this is something like, we've talked about economic moats before, and it's something that's like, I believe that's very important to me. I don't think you can have like those characteristics we were just talking about, at least for a sustained period of time, if a business does not have an economic moat or just a competitive advantage. And if you're not familiar with that, you should probably listen to that episode we did on Pat Dorsey's book. But this test, like I do for all my companies, like it's when I'm investing in a new company, like I'll just like imagine, and because I know like Warren Buffett used this test, like, okay, if Warren Buffett or if I had billions of dollars, could I start a competitor to this business? So if it's something like Chipotle, like oftentimes the answer is like, yeah, I could, like I feel like, if you gave me billions of dollars to make a Chipotle competitor, I could make a reasonable competitor to Chipotle, which is not a knock on Chipotle. Like, I'm not saying you should or should not invest in Chipotle, but just something like I look at, I'm like, Chipotle might not be an investment I'm interested in. But then when I think about Google search or Amazon's, e-commerce business or Meta's like, family of apps or MasterCard and Visa's payment networks, and then I'm like, and I can't fathom building a competitor to them and how I would do that. And when like to me, it's just a very good mental exercise to run through, like when you're like looking at a new company.
Yeah, that is a great example, and probably the ultimate example that Buffett applied that was, I mean, I guess there are lots of examples, but two that come to mind are like Moody's and Coca-Cola. So, how could you recreate Coca-Cola and Moody's moat? Like, I really don't think you can. Moody's, for example, how are you going to integrate yourself as a ratings agency into all of the Wall Street banks and then get them to start using your ratings over one of the existing companies like Moody's or S&P? Like, you can't do it. Like,
Can't.
you could throw so much money at it and it's just not something you could do. So like, those are the kind of businesses you want where it's just very difficult to disrupt them.
Yeah, absolutely. Absolutely. But I thought it's a useful test that I use, and I was glad she pointed it out. I think
Yeah,
it's a
absolutely.
very good test.
Yeah. So we touched on this, I think, when we talked about Pat Dorsey's book, but I think it's important to touch on here. So this methodology of looking for consumer monopolies, this will keep you out of newer companies that don't have moats but have tremendous potential. So how do you think about that kind of contradiction? Like, if you're looking, like we talked about 100 backers, and in that situation, you're looking for companies that are new, that have huge potential and may not necessarily have a moat. So how do you think about that kind of situation?
Yeah, so that's look, there's many ways to skin a cat,
Yeah.
right? You just have to like accept that. Like, like I think like reading about these different types of philosophies is good. And like I think one will probably better suit your personality and temperament than others. And some people have that mindset, that like that Chris Mayer mindset, or I would call it like almost like a Motley Fool mindset, where you go out and you buy Amazon in 1999 and Netflix in 2001, and you have a lot of misses along the way, but like those kinds of hits will carry your returns to be great. And then others, like, which is more where I fall, like I don't like having misses. Like I just don't do well. Like I could have 18 companies doing well, and the two companies that are doing bad out of like 20 companies I own, like they'll just drive me crazy and they'll take up all my mental bandwidth. And I just, don't get me wrong, I still have plenty of misses. Like, but like I'm more looking at companies that still have plenty of room to grow. Don't get me wrong, but like that I think have proven economic modes. I think there's a sweet point where you can look like, I see what this company's trying to do, And I see like how they can develop this economic moat or how they are developing an economic moat. And like you can still catch them at the early stage. I mean, that's the absolute sweet spot, which by the way, I've only managed to do, a very few times, like in my investment career. But like, I think there are times like within your circle of competence, and you go back to like that Peter Lynch philosophy of just like companies you just maybe understand more on a visceral level because that's the industry you're in, or that's like your hobby, or just like a consumer activity you're very attuned to. But I think you have to one learn about the different types of investment strategies and philosophies, and then just do what's best for you. I think there is a Venn diagram though, where you can use up almost everything what Chris Mayer said and use everything like that Buffett says. And I mean, hopefully that's what I'm trying to do. How do you think about that?
Yeah, I mean, so I like everything that Chris Meyer talks about, but I think of it as like more of like I'm not looking for 100 baggers, but like I acknowledge that most of the companies I buy aren't going to be 100 baggers, but they can be 10 or 20 baggers over over
Right,
the next
right,
10 or
right,
20
right.
years, and that's pretty good. But you can apply the same concepts like, do you see the growth runway? Do you see like the valuation is it reasonable and will it grow over time? Will this company be able to continuously grow earnings? And I think you can combine that with the concept of predictable earnings and moats and get very solid rates of return that are pretty reliable. That's kind of how I think about merging the two ideas.
Absolutely. She talks about management in companies, and like how, I mean, look, I mean, she talks about honesty, which is, I mean, obviously very important. But again, it's reading these books over the last couple of years with you, like you start to see the same themes pop out. Like,
Mm-hmm.
when Pat Dorsey talked about like, hey, the characteristics of a business are much more important than management. And you see that here too. She goes, poor businesses often are just that, and no amount of managerial talent is going to make a difference. If you had two ship captains and one was much more experienced than the other, who do you think would win a race if you put the more experienced captain in a dinghy and the less experienced captain in a speedboat? It doesn't matter how good management is if the business suffers from inherently poor economics. I mean, we've talked about this before, but you want to opine on that?
Yeah. I think that you want to have businesses with good economics, and yeah, it's hard to figure that out sometimes, but I think it's a good kind of mental exercise to go through. Another, I think, a good mental model she had for getting at like the economics of good businesses was thinking about how they can respond to inflation, like how easily can they raise prices.
Some of the chapters on inflation were some of my personal favorites as far as like where I am, just like, inflation wasn't a big deal for most of the last 10 years.
Mm-hmm.
It's only really, I guess, in the last 3 or 4 years. Like, so in, if I started investing in like in earnest about 2014, so 11 years ago, let's say, and for the, first several years, inflation wasn't really on the radar then.
Mm-hmm.
It was like in the background. It could always be a threat, but it didn't really rear its ugly head. And then in the last couple of years, I mean, obviously, it's definitely been more of a presence in our economy. And so I just appreciated those chapters, which were interesting. And you're right, just like talking about like, can businesses raise prices to keep up with inflation, and how that can like look like good results at first might actually not be that great because it's just a result of more just like inflation.
Yeah, and I think it's important to think this through when you're thinking about a business and buying a business. How easily can they do it? So, if you're talking about, for instance, a can of Coca-Cola is already a pretty cheap thing for someone to buy to add to their grocery cart. It's already pretty a small percentage of the total order. So Coke can increase their prices by 20%, and that may not necessarily be enough to make you stop buying Coke. Apple, kind of another example. And I've been thinking about this with the tariffs. It's like, what is their sensitivity? So, okay, so they make a lot of the phones in China. China's getting all of these crazy tariffs. How much can Apple increase the price of an iPhone before tons of people will try to switch to some kind of alternative? And I think they have a ton of room to raise prices. I think, if you could double the price of an iPhone, and if your iPhone is broken, or either your contract is over or whatever, you're still probably going to buy a new one because you're stuck in that ecosystem. All your pictures are in there, or all your contacts are in there. It's easy to move to a new phone. You're familiar with the the operating system and how it looks, like they have a lot of room to increase prices, and I don't think it will impact them too much. So those are good businesses to think about and evaluate.
Yeah, absolutely. I think it's the Piper. Is it Piper Sandler does like a teen survey like twice a year, and they always show the teens and like what kind of smartphone they have. And it's like Apple 90%, 90+%. But then like the more important question I think is like how many would consider buying a new type of smartphone? Like when you have to buy when you upgrade the next time you buy a smartphone. And it's always like I mean, it's like nobody's considering switching from Apple to another smartphone. So yes, I agree. They have lots of price room, and there's services like that too. Like I mean, Amazon Prime or Netflix. Like like if they raise Netflix prices by $5 a month or Amazon Prime numbers by like whatever a month, I'm not switching because of that. Like I kind of rotate streaming services. I'll switch because of that, but like Amazon Prime is like a mainstay. I'm not. We get so many Amazon packages, it's ridiculous. And like there's no way I'm giving up my free shipping, my quote unquote free shipping, and not paying Amazon Prime.
Yeah.
So, there's like I think like thinking about through things like that too, like the pricing power of these companies is important. And Microsoft, I wouldn't even notice. Like I mean, obviously, I work for a government agency, and there's a ton of Microsoft products there. And I don't, I'm not involved in that process. But as a consumer, Office 365 and Windows and all that other stuff, like I mean, I'm in my mind, I'm paying Microsoft. Like they could, I don't even know what they charge me, and it's like I almost like, well, whatever they charge me is what they charge me because I need these products.
Yeah, absolutely. Yeah, and yeah, Microsoft's a good example. Like if you're like a business that relies on Excel or something, are you gonna like say, well, let's save 0.5% of our budget by switching to some other alternative? And like, no, you're not gonna do that. It works. You're gonna stick with it.
You're going to use the
Uh,
Office products. You're going to use Windows on your desktops. I mean, at least 90 some percent of businesses will. And when you stop paying the Microsoft bill, I mean, that's like the last bill you stop paying before the lights go out. You know,
yeah, that's a good point. That's a good point. So another thing I thought we should talk about before we wrap up. So at the end of the book, she shows you 54 companies that she considers to be consumer monopolies. Now, some of these did not age well. Some of them aged very well, and I thought it was fun to look at some of those. So some that didn't age well. So in this list, she's got Bear Stearns, Circuit City, and General Electric.
right?
So what'd you think about that whole dichotomy?
Well, yeah, on a high level, I took away the exact same things you took away. Like, oh, some of these don't age well, and some of them did. And like I think you'll get that in any kind of business book, right? I mean, I think you can look at like Peter Lynch talked about specific businesses, and some of them aged very well. Like,
Mm-hmm.
remember, for some reason, I always remember Lynch talking about like Home Depot and how he was in it super early, but then he sold super early, and he's
Yeah.
like, just looking back, like, wow, what an idiot, I should have just held it. But then he talked about like restaurants too that are like, that have come and gone since like Lynch was here. And I think like, look, that is like, I don't think you're going to find an investment book. Even Pat Dorsey, when he talks about economic moats, and so these businesses will last, which is a much more recent book than this book, and some of those already have not aged well. And I just think that's kind of the nature of the beast, like we want to be long-term business partners, and the preferred holding time is forever, but that's just not the reality for a lot of investments we make.
Yeah, and I think that gets to the importance of diversification. You're going to own like any portfolio. You're human. You're going to get things wrong. The future is inherently unpredictable. You're going to have some that don't work out well. Now, she had many in this list that worked out tremendously. So, like some that stuck out to me, she's got Lowe's, McDonald's, Nestle, PepsiCo, Philip Morris, Progressive Insurance. Like, if you owned a portfolio of those companies, even if you owned like a Circuit City or a Bear Stearns that went bust, you're going to own plenty of great companies that did very well. And I think that will more than make up for, some of the poor results. But I think it's important to have a big enough portfolio where you can sustain some of those losses and you can have some things that probably won't work out.
And I think so. Actually, let me make a point that like so. I want to find this quote. Actually, give me 1 second. But like she talks about like newspapers a lot, right? Because back in the day,
Oh, yeah.
even as she wrote this, like newspapers were still a great business. And she talks about like if a town has two newspapers, commodity business, move on, it's not worth your investment. If a town has one newspaper, great business, they can charge whatever they want for advertising. And she has this little tidbit in here about advertising that's just kind of tucked away. It's almost like a throwaway line, but she goes, ultimately, advertising became the battleground on which manufacturers competed with one another, with huge consumer corporations spending hundreds of millions of dollars a year on getting their quote, buy our product, end quote, message to the potential customer. After a while, these companies found there was no turning back. Manufacturers had to advertise, or they ran the risk that some competitor would sweep in and take over their coveted niche in the marketplace. And I guess like the point like I was trying to take away from that was that like, okay, the medium has changed for advertising. The big broadcast channels, the newspapers in the small towns, like they're kind of obsolete now. And maybe not completely obsolete, but you
Hmm.
know what I mean. They're not what they used to be.
Yeah.
But when it has switched shifted to like Google and Facebook and those kinds of platforms, and those kinds of platforms are behemoths. So I think like, you take like the more higher big picture concept, the higher level concept that advertising is a great place to be as an investor. And if you're able to like be nimble enough to like switch that as mediums change. So as mediums change from newspapers and broadcast channels and cable even to, social media apps and Google search, etc., Amazon, like I think like remember the higher level concepts, I guess, things like advertising is a great business, and then try to just be nimble enough mentally to be able to shift like, oh, the medium for advertising is changing and I want to be ahead of that curve.
Yeah, absolutely. Yeah. I think that's a good, and I think that's a good way to think about Google and Facebook is that, and, well, within Facebook, you have Facebook and Instagram. And I think those three things are kind of where advertising is now. And it's a great business. And basically they're eating up all of the old, all of the old channels that used to be where you would do it. So I think they're just cutting into newspapers, they're cutting into local TV channels, they're cutting into the yellow pages used to be like a great place to put your stuff. And they're basically disrupting all of that, but it's still fundamentally a good business. It's just that it's moved to a different place.
Absolutely. And I know we're wrapping up, but the last thing I would want to mention, there's
Yeah.
two really good chapters about downturns. And one's just about a general market downturn, and one's about like when there's a specific company downturn, but just being able to recognize if this is a temporary thing or a more permanent thing. And I
Mhm.
really like the example she walked through about the specific companies. She talked about like Capital Cities, which owned ABC and I think ESPN, and
That's
how
right.
they had just a great advertising business, but there was like an economic downturn one year, so their advertising business didn't grow. And so then like it just like sold off tremendously, and it was a great buying opportunity. She talked about like in the 70s, Geico like just wanted to like they wanted to grow their business by adding drivers, but that didn't have good driving records. And so their profitability fell. Or American Express. This was a wild story. Did you know this American Express story
The
about the
salad
salad?
oil.
Yeah.
Oh yeah, so that's a big Buffett story. That was one of his great investments. It was the best investment of the partnership years. But yeah, it's fascinating. Like this guy, I forget what his name was, DeAngelis or
Anthony
something.
DeAngelis. Yeah. Yeah.
Yeah, he bought up like he basically used, so basically he was given credits or credit for his commodity, which was salad oil. And what he would do is he would fill up his tanks with seawater, put the top layer in as salad oil, and then say, oh, the whole tank is salad oil, and then be able to get credit for it. And then he would go out and gamble that in the market and commodities investing or trading or whatever. And yeah, it turned into a huge problem for American Express because they were the ones extending him credit. And that Buffett, after the stock collapsed because of that, Buffett went in and said, hey, this is still a good consumer monopoly. And he bought up the stock and made a ton of money from it.
He did. He did. And just this, if you're looking at more modern examples of that, like I think you could throw in like what Netflix was talking about, like spinning out Quickster and their DVD business at the time. And I mean, I want to say the stock fell like almost 50%, like until they
Wow.
burst that decision, and that was 2011, 2012, maybe. But yeah, I mean, there's just more modern things of that. But like, I think it's like a very important concept when you know a business really well and you can look at things and say, okay, this is a temporary problem, and the company's going to work through this. The food poisoning at Chipotle, whatever that was, like 5 6 years ago,
Hmm.
when they had that incident, the stock fell a lot. American Express, when they lost the Costco business, do you remember that, like 10 years ago? Like, American Express was the exclusive provider of the Costco credit card, and they lost that business and went to Visa. And so American Express stock fell tremendously on that news. And there's just plenty of examples of that. I think Meta a couple years ago, when Snapchat was like coming on as competition, or TikTok, and Apple was making privacy changes, and Meta stock fell tremendously. When you know a business really well, you're not going to be able to hit on all those. Don't get me wrong. I'm not saying as an investor you can hit on all those, but you should be able to try to recognize at least opportunities within your wheelhouse, your circle of competence, your portfolio. When, like, oh, this is a great opportunity to pick up more Meta stock. Oh, this is a great opportunity to pick up more American Express or Netflix, Chipotle. And I thought it was a very well written chapter on recognizing those short term opportunities that the market gives you from time to time.
Yeah, that's a great way to think about it. And it's hard to know a lot of times whether or not it's temporary or permanent. But yeah, I think if you're sticking to good businesses with economic moats, generally speaking, it's temporary and it's usually a good buying opportunity.
Absolutely. And
All
then
right.
the same thing about the market downturns, but just general, like you talked about the crash of 1901, which I didn't know much about, and the crash of 1987, which I think we're more familiar with these days. But just like,
Hmm.
hey, market volatility can give you opportunities in the marketplace. I mean, I don't think that's anything groundbreaking, but I just thought they were good chapters, reviewing that kind of stuff.
Absolutely, yeah. All of that stuff is really good opportunities. I know that 87, when everybody was out panicking, Buffett started accumulating Coca-Cola stock. So, you know, that's the kind of thing you want to do in those kind of environments. Find good businesses and see if it's an opportunity to scoop them up rather than panicking with everybody else.
Absolutely.
All right, well, thanks for coming on today. Anything you wanted to promote or talk about?
No, just like you can follow me on X at the Matt Cochrane, on there way too much. And once again, just thanks for having me on. I always enjoy these talks.
Yeah, me too. All right, thanks a lot.